Recently, I was reading this research article published by Value Research, which talks about 6 most bought stocks by mutual funds in the past 1 year. And I got very curious, which are these 6 bought stocks and why mutual funds are hanging around these 6 stocks. I did my research, and in this video, what I want to do is present to you 3 out of these 6 stocks and present to you something interesting about these companies. The intention is for you to learn about these 3 companies. It doesn't mean that I'm giving you buy or sell recommendations here. So the first stock out of these 6 stocks that I want to discuss is office space. If you look at how much of stakes mutual funds have increased, going back from June 2024 to almost September 2025, it's gone up from around 13.54% to almost 41.18%. And if you look at the FIs as well, they have also got their stakes higher up to 25%. Promoters have been selling in this particular company. But more importantly, what is so special about this particular company? For this, let me give you a couple of minutes of commentary. So Office Space is a flexible workspace company, right? And if you look at the past fundamentals of this company, what you would note is that, let's say FY21 to FY25, company's top line, the sales have grown at around 61% CAGR basis. Their operating EBITDA, which is operating profitability, has gone up by around 67% CAGR basis. Also, if you look at the net cash flow from operations, it's gone up at around 60% CAGR basis. So the company is generating more and more cash from its operations on a yearly basis. If you look at the ROCE, which is the return on capital employed, it has been going up at around 54% CAGR basis. Here, please note that this little asterisk you see, it means that it is a cash EBIT. So we all know ROCE is what? Return on capital employed, which is equal to EBIT divided by total capital employed. Here in this case, the company is declaring that this is a cash EBIT, meaning this is the measure of cash profitability. All in all, from this slide, what we can take away is that the company's sales have been growing every single year. If we can look at this chart, more importantly, the company is generating positive cash flow, and that has been growing at a very good growth rate, which is around 60% here on the chart. So from a long-term fundamentals perspective, you know the picture now. But if you look at the profit after tax of this company, last 4 years, which is 21 to 24 fiscal years, company was making losses. And in 24-25, company turned positive and delivered 68 crores of PAT. Now you should have a very natural question, Rahul, that this company is generating good cash flow that we can see every year, 60% of CAGR basis. Why is that cash not converting into PAT? Why is that the PAT is only 68 crores? That's a very, very good, interesting question. And this is how I typically go and get curious about companies and try to then dig deeper. When I was looking at their profit and loss statement in detail, what I found is that their finance cost, if you look at this finance cost here, depreciation and amortization expenses as well, they are very, very high. Now again, just to simplify this, what is happening here in my view is that the company is investing money and therefore their finance cost is high. And when you're investing in capex, your depreciation also goes up in the initial time period until you exhaust it. So therefore, it is all reducing their PAT. Although they are generating good cash, but the PAT is getting reduced because of these costs. The company is investing the money into business. That's the simplest explanation I could find and share it with you. Now coming to the question that why is the finance cost very high? Why is the depreciation very high? Very simple, because the company operates 2 business models. One is managed aggregation and second is straight lease model. Now this straight lease model is the one that is creating a little bit problem for the company in terms of increased finance cost. Because in this model, what happens is that they go and get a property from the space owner or the developer on the lease basis. And they pay to developer or the owner the full monthly rental, and they also spend money into the fit outs and capital expenditure, whatever is needed. Therefore, here they have to heavily invest money upfront. And therefore, here what you note is that the finance cost goes very high. While the second model, which is the managed aggregation model, here with the owners or the developers, they have a profit sharing model wherein they are not going to invest everything upfront. Even the developer or the office space owner, they will also put money in for the fit out, etc. They will co-invest, as you can read here. Therefore, here it is more asset light model. And what company has been doing is it has been gradually shifting towards managed aggregation model. If you can see the total seats under managed aggregation model, it is very high, almost double as compared to if I show you back the straight lease model. So gradually the company is moving towards asset light model. But as of now, because they also have these seats under straight lease model, the finance cost looks very high. The depreciation again looks very high in my view. And therefore the PAT is reduced, but slowly it is turning positive as we saw in FY25. Now coming to the prospects of this particular sector, very quickly, data point here is that the Indian flexible workspace, if you look at the inventory of the stock, it is projected that by 2027, it can go up at a CAGR of around 18%. So there is likely to be demand in this particular sector. And this demand is propelled by something called as GCC, Global Capability Centers. A lot of companies are setting GCC in India now, and that growth is around 7 to 8% estimated by 2030. That's what is driving some of this demand. And therefore, Office is now concentrating a lot on GCCs. As you can see here, H1 FY26, the highlights are that they have signed up 10 plus GCCs across 5 elite centers. That's the overall business summary that you need to take away for this particular stock. Of course, you can go and do a bit more detailed study about this company. While I can only quickly talk about some of their important valuation ratios as well. For example, let me speak about their PE ratio. The PE ratio has been coming down. It was back in June 2025, 114. It's come down to 75 because the company has turned PAT positive. If they continue to be giving more PAT, and if I assume that the price is constant, then of course the PE will come further down, provided their EPS goes up. We know that concept. But more than PE here, we are going to look at price to book, which is at around 7.7, again has been coming down. And we are going to look at EV multiples, which has also been coming down. So these are the valuation metrics here. It's sort of a very unique business, so comparing it with many other companies may not make a lot of sense. But this company, we have seen huge buying by mutual funds. What do you think about this company? Let me know in the comments. If you've done some research about this company, let me know in the comments. While let me present to you stock number 2. Second company that I would like you to learn about is Aptus Value Housing Finance India Limited. Full disclosure that this stock is in my portfolio, have been there for few months now. It's not that I've recently bought this, but I think I would like you to understand a bit more about this particular company. So first thing that we are going to talk about is the domestic institutions buying pattern in the last 1 year or so. If you look at from, let's say, September 2024, 9.48% to the stake has gone up to around 25.87%. While FI stakes have also gone up and promoters have diluted their stakes. In fact, one of their big promoters called West Bridge Crossover, they had completely exited this particular company, and that's something that you need to take a note of. But now let me give you 2 to 3 minutes summary view of their business model and financials and fundamentals. So primarily the company is focusing on the self-employed borrowers in tier 2, 3, 4 locations. So they are primarily giving loans for homes as well as for business. For example, if I talk about their total asset under management, around 11,700 crores, out of which 8,400 crore is towards the home loans and remaining 3,300 crores is for the small business loans, right? Now the management's medium term guidance that they are given is that this 11,700 crore AUM should go up to 25,000 crore AUM, more than double. And here the growth rate they are talking about is they are going to sustain around 25% plus growth in their asset under management. That's what the management's guidance is. Now if you look at the company's past track record of delivering AUM growth, here you will see the data, and between FY20 and 25, the growth rate in the AUM has been around 28% CAGR basis. That's what the past data is telling us. Now coming to this company's concentration, whether it's a pan-India player or not, as you can see in the green color here, this is primarily concentrated in southern part of our India. States like Andhra Pradesh, Tamil Nadu, Telangana, Karnataka, and now they have extended to Odisha and Maharashtra as well. If you're from south side of the India, then let me know in the comments if you've ever visited Aptus Value Housing and how has been your experience. Would love to know that. But if you have not yet visited, I would highly encourage that you go and visit them, see their operations for yourself. That would be good learning for you. You will get to learn about credit lending firms when you go and visit them. Now coming to this company's main problem right now, or rather a fundamental shift in their business model, is that in November month, they announced that they have stopped giving loans which are below 7 lakhs. This is a structural change. This is a change in the credit policy of the company. And of course, investors are now asking a lot of questions in terms of, if you're stopping giving loans below 7 lakhs, what does it mean to your disbursement? What does it mean to your AUM growth? To that, management says that it's a temporary situation and it's a conscious long-term structural decision that we have taken. Okay, it's a long-term decision. Now, of course, I do not know what can happen in terms of their AUM growth, but we'll have to track the numbers for the next few quarters to see how that is impacting their disbursements. For example, here their Q2 26 disbursement numbers grew 24%. Okay, quarter on quarter basis, year on year basis, I see definitely some softness here. It's only grown up by around 8%. It could also be due to the high lending rates, etc. Again, there are a lot of variables, not just one single parameter that we can decide. In fact, very recently, I wrote a detailed note for my member community speaking about these particular changes that the company has made. If you would like to get timely updates on various assets like these, then you can consider joining my YouTube community. Almost on a daily basis, I'm posting some content that is going to be very, very useful for you. Hopefully, it will give you insights from market and also for various assets like ETFs, mutual funds, stocks, etc. The feedback of this community has been very good. Simply go to my channel, find the join button and join this community if you want to. Now, coming back to this company's valuations, very quickly, I'll have a look at the valuations. Company's PE ratio at the time of recording this video is on 28th of November is around 16.64 versus industry 17.97. Price to book is at around 3.01 while the industry is at 1.83. PEG ratio is 0.63, which is less than 1. So these are the valuation metrics that you can make a note of. All in all, I've given you summary information about this particular company. Go and compare this with few other house loan companies, NBFCs. In fact, you can compare this with banks as well and compare how much is the AUM growth you're seeing in other companies versus this company. Look at the names, etc. And you might get more educated about the comparison as well. Hopefully, this analysis is giving you some insights about these companies and hopefully you are getting benefited. If you're liking this video so far, I request you to hit the like button. Subscribe to this channel because you're going to learn a lot without getting any biased opinions from me. I will just give you the straight data point and you decide whether this company is worth considering or not. With that, let me now move to stock number 3. The third company that I want to speak about is Crompton Greaves Electricals. If you look at this company's investors shareholding pattern, what you note very quickly is that there are no promoters in this company, only FIs and DIs, professionally managed company. And if you look at the DI stakes from, let's say, almost September 2024, it's gone up from 50% to almost 61%, while the FI stakes have come down from 36% to 25%. FIs have sold it, DIs have bought it. So let me now give you quick few minutes commentary about their business and what's happening in this particular company. First thing to note is that traditionally this company has been into, let's say, 3 main divisions: electrical consumer durables, ECD, like we use fans, etc., coolers, air coolers and fans, etc. That's around 76% of their business. Lightings, which is the bulbs, etc., is around 12.90% of their business. And the last one is Butterfly, which is their kitchen appliance subsidiary. That's where they're getting around 10.95% of their business. These were the traditional business segments that the company was operating in. And if you look at the growth rate of the company in the last 4 to 5 years, if you look at the revenue growth rate from 4,800 crore in FY21 to FY25, around 7,864 crores, roughly around 13% of CAGR growth in the top line. But if you look at the profit after tax, very interesting point here is that profit after tax is lower what it was making in FY21, which is 617 crores to 564 crores. So traditionally, the company's top line has been growing, but the profit after tax has been very, very flat, or in fact, it has reduced in FY25. One of the reasons that the company has been diversifying is maybe because of the PAT stagnation. The company has recently diversified into solar pumps as well as solar rooftops. And what management is saying is that this could potentially add around 2,000 crores to their top line in the next 18 to 24 months. Overall market size that the company says for in this particular segment is around 20,000 crores of market. So there seems to be opportunity that the company is chasing right now under the solar theme, and the management has been speaking about government interventions in terms of the Kusum policy, etc. So this is the diversification that the company is doing right now from a business perspective. Now coming to the latest results that the company has published, H1 FY26 has not been great for them. Top line has come down. Their EBIT, consolidated EBIT, has also come down. Margins also have compressed. Now, one of the reasons for this is the extended monsoons. So if you are tracking, let's say, white goods companies like AC manufacturing companies like PG Electroplast, you would note very similar pattern, because in India in FY26, the heat waves were not there. There was an extended monsoon, because of which the sales have come down. So it's one of those companies which is undergoing some pain right now because of monsoon issues in FY26, and therefore the profits and revenues are down. Now, whenever this happens, one of the important things that I typically do is look at the cash statement of the company to make sure that whether the company is having some cash reserves or not. So if I look at their FY24 cash position was around 130 crores, FY25 193 crores of net cash. So I was comfortable from cash perspective. If you look at the Operating cash flow as well, important for any company to generate operating cash. The company should not be burning a lot of operating cash, otherwise it's going to land into a trouble later or the sooner. So what we're going to do here is look at the cash flows. So if you look at operational cash flow in FY24, it was around 795 crores, and in FY25, positive operational cash flow of around 716 crores. So definitely company is generating operational cash flow. It is being positive. If you look at the debt position also, this company became zero debt company, and they published this in the press release in July 2025 that the company has achieved zero debt. That is very, very good from a balance sheet perspective. So I've talked about the P&L statement, given you the view on the cash flow, and also have talked about their balance sheet position in terms of the debt. Now, of course, because of the short-term pains that the company is going through, the PE has contracted here, and you can see, look at the last 5 years, median PE has been around 41. Right now, it is trading well below that, around 35. Because maybe there is a fundamental degrowth in the earnings, and therefore, right now, market is giving them a PE of 35, which is well below their median. If you look at, for example, EV multiples here, they are also well below median historical EVs. It's come down to 20 versus 27.2. And if you look at the price to book ratio, that's also well below median, which is median is 8.8, and that is around 5.1 or 5 at the time of recording this video. So in the recent times, valuation seems to have calmed down, maybe because the profit is not there, profit growth have come down. But could this company turn around because of the solar growth rate? That is something that is out there as an opportunity. Of course, management seems very bullish on it. I cannot really speculate or predict what could happen, but you do some research at your end and try and think about whether this company can gain some market share in the solar space or not. Can the profitability go up from there or not? Because for the company to be able to get some more attention from investors, they will have to deliver earnings growth as well as sales growth. So that's it. I've covered 3 stocks in this particular video. Let me know in the comments which stock you think is more promising and fundamentally strong here, and let me know in the comments what your suggestions are. I hope you like this video. I'm going to see you in my next video. Until then, keep rocking.